I tried to buy bonds just before Putin invaded Ukraine, which was an awful idea. And since then, I've been kind of paralyzed on my view on bonds, to be honest, because I think it is so tricky to grasp the inflation pressure right now. So I don't think you can buy bonds with a high conviction because the outcome space is so wide. It could end up as a fantastic investment for the second half of the year due to growth reasons, because when growth is slowing, bonds tend to perform. But the inflation cycle is the dark horse here. And if politicians keep throwing money at the problem, then the inflation cycle won't turn. And I don't really like to be on the same boat as politicians in a bed. So,
that's a lonely boat right now, Andreas. Not many people want to be sharing that space.
Exactly. So, I mean, by the end of the day, I'm leaning long bonds, but it's not a high conviction. Because the growth cycle clearly points towards buying bonds, but the inflation cycle is very tricky.
And that, in a nutshell, I think is what so many have been struggling with and have been burned with. And I think many are doing it, dipping their toe in and trying to be very nimble and careful. But this is the dilemma everyone keeps knocking up against. Valtteri is asking, and I'm going to ask you this. Don't know if you've been following this, because if you don't follow Luke Gromen, you won't know. But asking if what you think about the Luke Gromen view of inflating the global sovereign debts away.
Well, I think Luke is right. If you look at the debt levels in the US and Japan, in Southern European economies, I think the only political palatable way to get rid of that debt load is to ensure that real interest rates remain negative for the next couple of decades. Because if you try to get rid of that debt load via other methods, it essentially turns into a much more painful process. And usually in a democracy, you will vote for someone trying to get rid of that debt load in a more palatable way. And the most palatable way is basically to ensure that real interest rates are negative. I mean, of course, there is a bill when real interest rates are negative. That bill is called inflation because it essentially means that inflation will need to run hotter than nominal bond yields for the foreseeable future. And it also means that risk assets will likely receive the tailwinds from negative real yields for as far as I can see for the next couple of decades still. So that makes me positive on risk assets. And I think that's, even though I'm saying that a recession is a done deal, I'm actually in the camp that equities look almost cheap by now, at least average. So I don't consider equities expensive despite this recessionary risk. And if Luke is right on his theory of negative real yields forever, then of course you need to be positioned in equities throughout such a scenario.
That brings up the point of what a portfolio should look like. We just talked about difficulty in bonds. You can see from the market action on some days that there are people who are looking for a bottom or looking to try to put money to work in equities, or at least certain names, but they have been swamped. And there are plenty of people who think there's still 10 to 15%, if not more, downside. I mean, I've been, seeing people talking about the S&P 500, which if I pull up where we were today, 4,106, so 4,100's, easily talking about a 3,500 handle on that, or even lower. Those are the bears, but there does seem to be a lot of risk. Are you adding to equity positions right now? And is it US or is it elsewhere?
I'm not adding to it, but I'm staying long risk assets in my structural portfolios. I'm not selling them because I think they look, on average, fairly priced. They're not expensive, they're not cheap. But if you look at the tactical horizon, the next 6 months, then if I'm right on my prediction on the ISM manufacturing cycle, the growth cycle globally, then of course equities could drop, let's say 10, 15% from here. But then by the end of this year, they will look very cheap also on forward-looking multiples if that drawdown of 10, 15% is in place. So I would use weakness to buy throughout the second half of the year on a structural basis. But if you're looking for short-term bets, then I am leaning towards the short side on equities. But into such a scenario with a recession upcoming, say late this year or thereabout, you need to look for so-called dividend stocks. Cash flow predictability is highly valued in such a scenario, which means that equities linked to healthcare could be good. Equities linked to the utility sector could be good, and maybe also equities linked to the residential real estate sector could be good, because those are three sectors with high predictability in cash flows, and also partly inflation hedged bets.
Mm. There's been a lot of discussion about diversification, right? I mean, this has been really challenging because things have been moving down together in a way they haven't. So when you look for weightings of portfolios, is there, what, if any, role should commodities be playing? Should metals be playing? What about food commodities? How are you thinking about that whole asset class? It's been a great run. But I think people are nervous about a reversal if we were to get any surprise news.
Yeah. In my structural model portfolio, I hold around 5% precious metals and 10% in a broad commodity index, including food commodities. And I basically aim at always having that position on in a structural portfolio. It's been a good hedge for me, because otherwise my portfolio would have been down by much more this year. I'm down a bit, but it's not that bad. And that the part of the portfolio that basically saved me throughout the spring was the commodity position. So into this scenario during the autumn, I would probably rather add a bit to the commodity basket, in particular in the precious metals sector. Because, I mean, by the end of the day, it's a good idea to have a bit of your portfolio positioned in that sector into a slowdown.
We haven't talked about currencies. The dollar strength is an issue that comes up in almost every conversation we have. Concerns about the implications of that. What are you looking at on the currency front?
Well, I've been long dollar for quite a while, and I tried to add to that position lately via the UUP ETF, and it seems as if the euro has taken the upper hand in the FX space, simply due to the fact that the inflation cycle in Europe lags the inflation cycle in the US. So there's a lot of catch up to be done by the European Central Bank compared to the Federal Reserve. But otherwise, into a cyclical slowdown and into a potential recession on a global scale, I would strongly advise people to have a long dollar position, in particular if they're based in Europe, as I am, because it's the perfect anti-position to have in your portfolio, since it protects you against the gale force winds that could be blowing into such a scenario on risk assets. So I would clearly lean long dollar.
There's a lot of weather analogies going on, right? we had, I think you're referencing Jamie Dimon in the hurricane comment. But there does seem to be a very high degree of worry. I mean, we do have all of these sort of, different shocks that are trying to work out. And as you so eloquently put before, hard to get a conviction when you've got countering forces. What is the risk you most worry about right now, Andreas? What concerns you most, especially because the timing seems a little fluid on the recession that you do think is coming?
Yeah, I have a lot of equities in the consumer staples space, which has been a decent position during the spring here, as in times of inflation, people tend to just buy necessities, right? And then consumer staples reflect that. But I'm a bit worried that margin expectations are too high for equities like that. Also, as a consequence of that space of the equity market being a bit overcrowded. So that's essentially my main worry for the autumn, that expectations for earnings are simply too high, and if the cyclical slowdown gathers pace in a negative direction, then we may be faced with a very negative surprise to the earnings outlook.
I'm going to squeeze one more question in. This is from FR. Is Andreas bullish on any green commodities, i.e. lithium?
I have a bit of uranium in my portfolio. I guess that could be considered a green commodity. So, I mean, I wouldn't rule out taking positions in that space either, since I already indirectly have it. So why not?